In this episode, we're going to look at the power of reinvesting your dividends. I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this episode, we're going to cover the following 4 topics. What are dividends? How do you reinvest your dividends? Dividend reinvesting examples, and we're going to look at some real life examples. And then topic number 4, what are the benefits of reinvesting your dividends? Let's get started with topic number 1. What are dividends? You might be familiar with this company up on the screen, Apple. They are the makers of the MacBook, the iPhone, the iPod. And so this company today currently has a little over 15 billion shares outstanding. If you were to buy all of the shares, you would own the entire company. But if you were to buy just a single share, maybe 5 or 10 shares in the company, you are still considered part owner of the company. And as part owner of the company, you're entitled to share in the profits of that company. And those profits come to you in the form of dividends. So in this example, you can see it up on the screen. If a company is paying a dividend of $1 per share and you own 1,000 shares, you'll receive $1,000 every year for as long as you own those shares and as long as the company continues to pay the dividend. Now you can take that dividend and you can spend it if you wish, or you can reinvest it. And that's our topic for today's episode. The dividends are automatically deposited as cash into your trading account as soon as you receive them from the company. Now, there are a couple of misconceptions out there about dividends. People have a lot of questions about what happens if the stock price goes down. How often do companies raise the dividend? How often do they cut the dividend or eliminate it? Are dividends even guaranteed? So I cover all of that in episode 57. So if you haven't seen it, go back and watch episode 57, and we cover all of the misconceptions around dividends. Now, with dividends, you're essentially getting paid just for owning the shares in the company. Now, why do you want to get paid for just owning the shares? Well, for this example, we're going to take a look at Microsoft. And you can see from 2002 to 2013, so we've got an 11-year period, and you can see it up on the screen, the stock price. And stock prices go up and down all the time. But you'll notice something very unique here. From 2002 to 2013, the stock price didn't go anywhere. For example, in 2002, Microsoft was trading at around $28 a share. Fast forward 11 years later, the company was back trading at $28 a share. So without any dividends, if you calculate the capital gains or your profit from buying Microsoft in 2002 and then selling it at 2013, basically it's zero. Your return is 0%. Now, the good thing here is that Microsoft does pay a dividend, and they were paying a dividend. In fact, in 2003, they started with a dividend of 8 cents a share. And you can see it up on the screen. We've got it listed for 10 years worth of dividends. And the dividends went up to 89 cents by the time we got to the year 2013. So now if we calculate the total return on your investment during that 11-year period, and we're including dividends, you can see that the return was 18%. Now, that might not be a huge number for most of you. That's not a big return over an 11-year period. However, it is much better than making 0% on your investment. Now, in fact, the dividend has gone up and up and up. As of this recording in the year 2025, the dividend today is $3.32, and the stock price is way high now. It's over $380 again as of this recording. So dividends provide you with a return on your investment while you hold on to those shares. It provides a margin of safety against stock price drops. If the stock price goes down, Hopefully you're still getting a dividend. Hopefully the company is growing the dividend every year. That is still money in your pocket. And increasing dividends over the long term actually help to raise the stock price. And we saw that with Microsoft. It went from $28 a share to over $380 a share. And during that period, the dividend has gone up considerably. So without dividends, you just need to keep hoping for stock prices to keep going up. But hope is not going to cover your expenses. Only dividends can do that. Let's move on to topic number 2 then. How do you actually reinvest your dividends? So there's 2 ways to do that. The first method is the dividend reinvestment plan, or a DRIP. So you can apply for the DRIP. If you have a trading account, you just need to contact the company, tell them you want to set up a DRIP for whichever stocks you own, and then they can do that for you. The second option is the do-it-yourself option. So we're going to look at both. Let's take a look at the DRIP first. So essentially what this means is that when you enroll in the DRIP plan, your dividends are automatically used to purchase more shares of the stock. So let me put it another way. So instead of getting the cash dividend deposit into your trading account, you are going to get more shares in that company. So instead of getting the cash, they're just going to reinvest it into the stocks that you already own in that company, and you're just going to get more. Now, you have no control over at what price those shares are bought at. Whatever the stock price happens to be on that particular day when the dividends come in, that's the price they're going to get bought at, and you are going to get the shares. Now, some companies give you a little bit of a discount. Some of them don't. Some of them will give you the extra shares and not charge you the commission or the trading fee. So that's another benefit there. Now, there are pros and cons to using a DRIP. And, one of the pros is that it's sort of hands off. Once you set it up, you're done. You don't have to worry about it. Automatically, every quarter, as you get the dividends, they're reinvested. Okay, so that's good. The downside is you have no control over the stock price. So if I bought shares in a company when they were $25 a share, and now the shares are trading at $300 a share, and they're overvalued, I don't want to be buying more shares in that company. But with the DRIP, you have no choice. It's just going to reinvest it at the higher price. So if you want to learn more about DRIPs, what they are, how it works, all of the pros and cons, I cover all of that in episode 13. So go ahead and go back and watch episode 13 if you're interested in learning more about the dividend reinvestment plan. Let's move on to our option number 2, which is my favorite, which is the DIY, do-it-yourself option. And what you're going to do here is you're going to collect your dividends, and they come in every quarter. Every company pays dividends at a different time based on their fiscal quarter, right? So the dividends are going to come in. Some companies pay a dividend every month. Most of them pay every quarter. So step 1, collect the dividends. Step 2, wait till you have enough money, right? There's no point going out and buying shares when you've got $10 in dividends or $100 in dividends. Want to make sure you've got a little bit of money in there, $500 or even $1,000. And then you can move on to step number 3, is then you invest that money into quality dividend stocks that happen to be priced low at that time when you're ready to buy. So you may just buy once a year, maybe twice a year, depending on how many dividends you get. That's okay. But step 3 is important. We want to invest in quality stocks when they're priced low, right? I gave that example before. If you bought the shares at $25 and now they're trading at $300 and they're overpriced, we don't want to be buying more shares in that company when they're $300 a share because they're overvalued. They're priced too high. Okay, so that's sort of step 1, 2, and 3. The key here is quality, not just any company, quality company. It's got to pay dividends and it's got to be priced low. Let's move on to our topic number 3. I'm going to give you some examples. We're going to take a look at a real life example of dividend investing and reinvesting those dividends, and let's see what happens. So what we're going to do is we're going to cover 2 scenarios. Scenario number 1, we're going to assume that you're not reinvesting the dividends. You're just going to sit on the cash, the dividends as they come in, or you're going to spend them, right? So some people do that. Dividends come in and they use it to spend the dividends. And that's perfectly fine if you are at that stage in life where you're retired or you're living off of your dividends and you need the dividends to cover your living expenses. That's fine. We're going to talk about somebody who's a little bit younger, maybe in their 20s, 30s, 40s, or 50s. They're still working, so their day job covers the living expenses, okay? And so what we're talking about in today's episode is, should you reinvest those dividends or should you just hold on to it as cash? Okay, so that's option number one, is not reinvesting the dividends. Option number two is we're going to look at, okay, what happens if you reinvest those dividends? Okay, so which option is going to be better for you? All right, so let's take a look at option number one. Now we're going to keep this simple as we can make it. And we're going to start off with, let's say, a $10,000 investment. So this is somebody who's got a $10,000 available to invest. And in this example, we're going to assume that they take that entire amount of $10,000 and they put it into TC Energy. Okay, so we're using this company as an example, and we're going to look at a 25-year time period, because that's when you can really tell if things are going to make a difference, right? Our short time period of 3 months or 6 months or even a year is too short to figure out, is scenario one better or scenario two better? So we're going to look at a 25-year time period. So $10,000 invested in TC Energy back in 2000, okay, would allow you to purchase 833 shares. Okay, because the stock price at the time was low, so you were able to buy 833 shares. Now we've rounded up to a whole number. Okay, you'll see in a second, it doesn't come out to exactly $10,000, but it's very close. Okay, so there's a lot of numbers on the screen. Don't worry about it. What we're showing you on the screen is from the year 2000 all the way to 2025, and we're showing you the dividend per share every single year. So the company was paying a dividend back then of 80 cents a share. Then you can see they increased it the following year, then they increased it again. In fact, for 23 years, the company had consecutively increased its dividends. So that's a good thing. Unfortunately, in 2024, they cut the dividend by 2 cents. And then in 2025, they reduced the dividend by 30 cents. So as dividend investors, we don't like to see dividend cuts. Nevertheless, this is what TC Energy is doing. They had a great track record of growing the dividend, but now they've had 2 years of where they've reduced the dividend. Nevertheless, you can see that, and on the final column on the right-hand side is the dividend income each year. So it's simple. We take the number of shares that you have, multiplied by the dividend per share, and you can see in the first year, in 2000, you would have made $666 in dividends that year. In 2025, if you hold on to the shares till the rest of the year, you'll make over $2,800 in dividends. And if you add it all up, you're looking at over $45,200 in dividends alone, which is not bad, because remember, you invested $10,000 in this company. And over that entire time period, you've now made over $45,200 in just dividends alone. And you still own the 833 shares in the company. So you can see it here. We've kind of summarized all that into a smaller table. So back in 2000, you bought 833 shares. Again, we're using whole numbers. We're not putting in fractional shares here. So you can see the stock value was $9,906. So pretty much $10,000, right? We're off by $4 here. So $10,000 in the first year, like I said, you would have made $666. And so we start off with $10,000. Today, as of this recording, the stock price, of course, has gone up. So if we're looking at the stock price alone, it's worth roughly $55,000. So that is the total value of the 833 shares that you own. And like I showed you in the previous slide, you've made over $45,000 in dividends. So your portfolio total value for this investment would be worth a little over $100,000. So again, not bad. You started with a $10,000 investment. and today it's worth a little over $100,000. Okay, now this is scenario number one. So we're assuming the cash dividends, the 45,000 you received, is just sitting in cash in that account, or you spent it. If you spent it, then your portfolio value is $55,000, right? That's just the value of the stock itself. Now, if the dividend remains the same, the current dividend as of this recording, and it doesn't change, you would expect this year to receive $2,832 in dividends just from this investment alone in TC Energy. So now let's move on to scenario number two, reinvesting those dividends that you would have received from TC Energy. So here's what we're going to do. We took the same table we showed you before. So we're going back to 2000 when you first bought the 833 shares in TC Energy. Okay, and you can see we've got all the dividends listed in there. You can see the dividend income, same as before. It's up on the screen. And what we're going to assume here is that every 5 years, this investor took the dividends from, in this example, TC Energy, and bought shares in another company, another dividend-paying company that was undervalued at the time. So you can see from 2000 to 2004, this person made over $4,000 in dividends. Okay, we're going to assume that was December 31st, 2004. So they ended the year with $4,115 in dividends. And then in 2005, January 1st or January 2nd, they took all that money and they reinvested it into a new company that was paying dividends, and it was undervalued at the time. Okay, so in 2005, they are going to make a purchase of a new investment into a different company. In 2010, they're going to do the same thing. So whatever dividends they got from 2005 to 2010, they're going to invest into another company. In 2015, same thing. In 2020, same thing. And in 2025, same thing. So you can see we've highlighted those values. Every 5 years, this person is taking those dividends and reinvesting it into other dividend stocks that are undervalued at that time. So you can see we end up with 1, 2, 3, 4, 5. 5 additional companies that they are going to buy during this 25-year time period. And I'm going to show you exactly what those companies are, and then we'll see how much they're worth today, and see if it was worthwhile doing this additional work versus just sitting on the dividends or spending them and not doing anything else with them. So let's get started. So from 2000 to 2004, like I said, this investor received $4,115 in dividends from TC Energy, and they took all of that money and they invested it into a stock called GPC, so Genuine Parts Company. So that was back in 2005. Put all those dividends into GPC and then held on to this stock. So now remember, this investor has TC Energy plus GPC. Now let's fast forward another 5 years. So from 2005 to 2009, TC Energy gave them an additional $5,681 in dividends. Okay. Now remember, they bought GPC 5 years ago. So from 2005 to 2009, they received $900 from GPC. So if we add up the dividends from TC Energy and GPC, we end up with $6,581, and all that money, which was in the form of dividends, gets invested in 2010 into a company called Cardinal Health. You can see the stock symbol there, CAH. So Cardinal Health, and they took all that money and invested it in there. Now we're going to fast forward another 5 years to 2015, okay? So now from 2010 to 2014, you can see over $7,300 in dividends from TC Energy. They still own GPC, and they got another $1,200 from GPC during that time period. And now they also have Cardinal Health that they've owned for 5 years, and they got $975 from there. If we add up all three of those dividends from each of those three companies, In 2015, this investor took the money, $9,536, and put all of it into a stock, into a company called Reliance. So stock symbol is RS, and all that money went into there. We're going to fast forward another 5 years to 2020. And so you can see TC Energy is still giving them dividends from 2015 to 2019. You can see it up on the screen, a little over $10,000 in dividends. They still own GPC, and they made over $1,700 in dividends. They still own Cardinal Health, another $1,700 in dividends. And now they, of course, own Reliance, RS, another $1,600 in dividends. So let's add up all the dividends from the 4 companies that this investor owns. And you can see that in 2020, they took all that money, which was $15,580, and invested it into this company here. The stock symbol is UNM. And we're going to do one more, and then we're done. So we're going to fast forward to 2025. Beginning of 2025, so January 1st or January 2nd, beginning of the year. Again, they've received in the last 5 years from TC Energy over $14,700 in dividends, another $2,200 in dividends from GPC, $2,000 in dividends from Cardinal Health, another almost $3,000 in dividends from Reliance, and another $3,500 from UNM. And if we add all that up, in 2025, beginning of the year, this investor invested over $25,500 in a stock called Universal. The stock symbol is UVV. Now, in all of these numbers that we've gone through, keep in mind, this investor started with $10,000 back in 2000. They did not add an extra penny out of their pocket into this investment. All of these companies that we've just looked at were purchased by using dividends initially from TC Energy, and then using dividends from TC Energy, plus all of the companies that they've been buying every 5 years. So no additional money was added to this portfolio. Now, if we look as of this recording, you can see it up on the screen. TC Energy, they still have 833 shares. Okay. GPC, they were able to buy 125 shares. Cardinal Health, they were able to buy 206 shares. Reliance, 173 shares. UNM, 537 shares. And then UVV, 513 shares. You can see all of the values. I'm not going to read them out. So as of this recording, you can see what the stocks are worth. This is not including dividends. This is just the value of the stocks, just going based on the stock price. And you can see that now this investor owns these 6 companies. They started with 1 and they own 6. Those are now worth over $212,000. Now we're going to go back just quickly. We're going to jump back to scenario number 1. I just want to show you the same numbers we looked at originally. So this person, scenario 1, invested $10,000 in TC Energy. By 2025, the stock is worth over $54,000, and they've received over $45,000 in dividends. So the portfolio is worth $100,000, roughly $100,000. If they spent the dividends, then the portfolio is worth roughly $55,000, right? So that's where we stand today. Let's compare it back to back with our scenario number 2. So scenario number 1, we're going to assume they did not reinvest the dividends. They just kept them in cash in the account. So the portfolio is worth a little over $100,000, right, including dividends and capital gains. Ongoing dividends, they're going to receive, like I said, if the dividend doesn't change for TC Energy, they'll make $2,832 this year, and every single year if the dividend stays the same. So this is a gain of over 900%, which is pretty good. Now, it is a long period of time. It's 25 years. But this investor has taken a $10,000 investment, and it's now worth a little over $100,000. So a gain of 902%. So let's see, how did scenario 2 perform? Did it do better or worse? So if we take scenario number 2, we can see that the portfolio is now worth over $212,000. And the ongoing annual dividends from all 6 companies, now assuming the 6 companies don't change the dividend, this year the investor will make a little over $7,160 in dividends. And so that's incredible. That's more than double what they would have made in scenario 1. So that's one benefit right there. The dividend income has more than doubled. And again, the investor did not invest any more money into this account. In both scenario 1 and in scenario 2, we're starting off with a $12,000 initial investment, and that's it. $10,000 initial investment in both scenario 1 and 2. So the annual dividend income, of course, ongoing income has more than doubled, and the portfolio, of course, has more than doubled. We're looking at a gain of over 2,000%. So that is a huge difference. If we look at the difference just in the portfolio value alone, by applying the techniques in scenario 2, which was reinvesting the dividends every 5 years, this investor is going to make over more than $111,000 in their portfolio value has increased by more than $111,000. Ongoing dividends, you can see the number there, an extra $4,300 a year in dividends. So let's finish up this episode. The last topic is the benefits of reinvesting dividends. I think you're already starting to see the benefits because the numbers show that there is a huge difference between scenario 1 and 2. So when you reinvest dividends, it helps to diversify your investments. In scenario 1, the investor only had one stock, TC Energy. So all of their money was invested in one stock, TC Energy. Now the company has done well, has upped the dividend, but if anything had gone wrong with this company or anything gone wrong with the industry or the sector that they're in, that's going to have a huge impact on the investor. Whereas in scenario number 2, they now own 6 different companies from 6 different industries and sectors. So they've now diversified their investment and reduced their risk from any one industry or sector or company tanking. So diversification is good. It's going to help you do that. The other benefit is it's going to help you to compound your growth because now you're taking advantage of dividend growth. You now have 6 companies. Each of those companies increase their dividend, except for TC Energy. We've seen the last 2 years, so they've gone down. Hopefully next year they'll be able to up the dividend. But the other 6 companies, the other 5 companies have been growing their dividend, increasing it as well. So companies will increase dividends at different rates. You get to take advantage of that. And guess what? The dividends that you're getting from these 6 companies is now going to help you to reinvest into other companies that pay dividends as well. So it becomes a snowball effect. With dividends, when you're starting off in the beginning, it's very slow, right? You're getting a little bit of dividend income. It's not a lot. Over time, that dividend income is going to grow. It's going to help you to buy more shares in other dividend stocks. They're going to pay you dividends. They're going to help you to buy more shares in other dividend stocks. So then you get that snowball effect. They're also good. The dividends themselves, and by reinvesting them, you're taking advantage of the dividend growth from each of the companies, are also going to help you beat inflation. So we cover all of that in episode 11. If you haven't seen it, go back and watch episode 11. We show you with real life examples of how dividends have helped investors stay ahead of inflation. And finally, by reinvesting, you're going to avoid the temptation to spend your dividends. If the money is sitting in the account as cash and you're going to see it all the time and you look at it every week or every month or once a year, you're going to be tempted to take that money out and spend it. And if you don't need it, you know, you've got a day job or you've got other investments and your living expenses are covered, well then it's going to be better for you in the long run to take that money and reinvest it. So There's a lot of benefits to reinvesting those dividends. So what's next? How do you get started with this? Okay. Our approach to investing is to invest in quality dividend paying stocks for the long term, and you want to invest in them when they're priced low. At the end of the day, we want to help you build a resilient stock portfolio regardless of what happens in the stock market. So how do you know when you're looking at a stock anywhere in the world if it's a quality stock and if it's priced low? So for that, I've created what I call the 12 rules of simply investing. The rules are designed to lower your risk, save you time, so you're not spending hours and hours and hours a week on research, and to help you earn more. You can see the 12 rules up on the screen right now. The goal here is to make sure that before you invest in any company, it passes all of the 12 rules. If it fails even one rule, skip it, move on to something else. Rule number 1, do you understand how the company is making money? If not, skip it, move on to something else. Rule number 2, 20 years from now, will people still need its product and services? Rule number 3, does the company have a low-cost competitive advantage? Rule number 4, is it recession-proof? Rule number 5, is it profitable? Rule number 6, does it grow its dividend? Rule number 7, can the company afford to pay a dividend? Rule number 8, is the debt less than 70%? Rule number 9, avoid any company with a recent dividend cut. Rule number 10, does it buy back its own shares? Rule number 11, is the stock priced low? So we're going to look at the PE ratio, we're going to look at the PB ratio, we're going to compare the current dividend yield to the 20-year average dividend yield. So there's 3 components to rule number 11. And then rule number 12, keep your emotions out of investing. Let's move on to our next slide here, which is the all-in-one solution. So that's what we're offering, is an easy, simple way to get started and to stay invested and to become a successful dividend investor. So the all-in-one solution includes the Simply Investing dividend course, and it includes the Simply Investing web application. And so the web application, you log in, it's going to go through, it's going to apply the Simply Investing criteria. So that's the best way for me to put it, is to apply the Simply Investing criteria to over 6,000 companies in the US and in Canada every single day. So you can log in and immediately see which companies to consider for investing and which ones to avoid. If there are stocks that are overvalued, the application is going to tell you that they're overvalued. If there's a stock that has a very, very high level of debt and it fails rule number 8, then the application is going to tell you that it fails rule number 8. And so you can skip it and avoid it. So the app is really going to save you a lot of time. It's taken us many, many years to build it and to get it to where it is today. And we've tried to make it as easy and as simple to use as possible. There's a lot of other features in there. You can track your portfolio. We've got a simulator in there so you can estimate what your dividend growth looks like in the next year, next 5, 10, 15, 20 years. And of course, it comes with the Simply Investing course. It's an online self-paced course. We've got 10 modules. Module 1, we cover the investing basics. Module 2, we cover the 12 rules of Simply Investing in detail. Module 3, I show you how to apply the 12 rules. Module 4, we show you how to use the Simply Investing web application. Module 5, placing your first stock order. Module 6, building and tracking your portfolio. Module 7, when to sell, which is just as important as to know when to buy. Module 8, especially if you have mutual funds, index funds, and ETFs, how do you reduce your fees and risk? Module 9, you're going to get your action plan to get started right away. And Module 10, I answer your most frequently asked questions. So this is our all-in-one solution. You may want to write this down, which is the coupon code SAVE10, SAVE10. It's going to save you 10% off of our all-in-one solution. If you enjoyed today's episode, be sure to hit the subscribe button, hit the like button as well. And for more information, take a look at our website, simplyinvesting.com. Thanks for watching.